So now, guys, it's the time to invite our next guest speaker to our call. And before I invite them, I would like to take this opportunity to introduce a little bit about them, about him and what he has done in his previous journey. So he has got a degree in building surveying. He has worked for Barclays as a business development manager. He has got more than 10 years experience in financial sector. Now he is self-employed and working as mortgage and protection broker, dealing with residential, commercial, and large-scale project financing. And of course, he is also an investor, and I have used his services many times, and he has helped me answer all my crazy questions. So I'm very happy to invite Shirin Patel in this virtual platform. Over to you, Shirin.
Thank you, Kushal. Thank you for the very warm welcome. Hi, everyone. So my name's Shirin, and I am a mortgage broker as well as a protection broker. Can't forget the protection. So I deal with both residential and commercial mortgages. So residential being if you're looking to buy a property to live in on a residential basis, as well as buying a property to invest, so buy to let. I also deal with commercial, so that encompasses bridging, that could be development finance, it could be large scale projects, as it says there, if you're looking to buy a site, so land and develop it, whether that's building flats or houses. So it's a vast array of kind of lending that I deal with. Yes, I've been in the sector for over 10 years now, and I have a team of brokers that I have that work with me. And yeah, so I'd like to spend some time today just to educate you a bit more about the buy-to-let process than some of the other stuff that I've just explained. And hopefully you get something out of this today. Hopefully it answers some questions in how buy-to-let works, what you should be looking out for, the market itself, and you know, I can answer any questions at the end that you may have. So Kushal, if you can move on to the next slide. So buy-to-let mortgages. Now, in the UK, property prices have risen quite a bit since World War II. And if we're looking at the ONS charts as of yesterday, I mean, average UK prices are up 10.6%, and that's a year to date in August. So that's a huge jump in prices, and a lot of that is to do with demand, a lot of that's to do with Brexit, a lot of that's to do with people wanting to move out. So maybe they were stuck in flats during COVID. But there's a number of reasons, which I won't go into, but that have led to prices to increase. And the annual price growth, which has been the strongest, has been up north. So where Mo is currently at the moment, you know, Scotland, for example, has achieved 16.9% in terms of the annual price growth. So it's crazy to see, you know, what house prices are doing, and what they've also done over the years. Now, inflation, I mean, so the chart below sort of explains or gives you a graph of kind of what house prices have been doing adjusted for inflation. And inflation for those is defined as the increase in price in goods and services over a period of time. So inflation can drive up house prices and can lead to many potential buyers being priced out of a property as well. So it goes without saying the UK has increased post-World War. In fact, figures from Nationwide show that since 1952, which is not in that graph there, but the average cost of a home was just £1,891. Now, to see that in 2000, that starts at sort of 150,000, you could see, you know, how much house prices has risen since the 1950s. And the cause of house price inflation is you know, factors to deal with, you know, purely economic principles of supply and demand. You know, when there's an increased demand for houses and a reduced supply of homes, house prices increase. And in recent years, housing demand has been very strong, especially in the 90s and noughties, as I say. And this, of course, changed with the credit crunch hit. So as you can see, it kind of dipped around sort of, well, since 2007, 2008, and then it started, finding its feet again after 2011 and 12. So, shortage of supply has long been a problem in the UK housing market, especially in popular areas. And consequently, this means that, there's a slight increase in demand, or even a slight increase in demand can cause a proportionally significant rise in house prices. And maybe some of the growth up north has been a result of HS2, which is potentially going to come in, but there's also been investment, as Mo explained, in terms of certain areas up north. And, all of these reasons are a result of why house prices continues to go up on a yearly basis. So I just wanted to kind of spend some time explaining that bit and, what we've seen over the last sort of 50 years or 60, 70 years in terms of house prices. And buy to let can be seen as a safe investment or a steady investment compared to other asset classes. So it's suited for medium and long-term investment, whereby you invest in a buy to let property, and you've got rental returns coming in, which can be reinvested again. And through one, you buy another, and you buy a third, and you buy a fourth. And a lot of the models that Mo explained earlier about the BRA and all those other models, you can sort of scale effectively. Buy to lets is also, as I said, regarded as a reliable investment. So as well as your stocks, shares, it's a very I would say a safe investment, but again, people can get hurt, as you would see in the graph before, where prices plummeted post the recession that we had last time in 2007 and 8. So as with any investment, there is risks, so that's something you do need to take into account. If you could move on to the next slide, if that's okay. Brilliant. So how does a buy-to-let investment work? So typically, there's a 25% deposit that's required, and that's 25% of the property value. However, the borrowing amount does depend on the rental income, and that's what dictates how much you can borrow. Some lenders do offer 20% deposit, and there is a myth that lenders do accept 15, which is correct. But with those lenders, there are higher stress rates, which means that the rental income needs to be quite high in order for that to work. So typically 25% is what would fit with most lenders, but depending on the area, depending on the rent, it could work with a 20 and 15%. Now, investor will look to find tenants to live there who will then pay rent each month. And this would then be used to cover the mortgage payments, which is known as rental income. And during the lifespan of the mortgage, the investment for the investor is to achieve capital growth, which is one of the reasons of investing. So what's happened over the last 50 years is a lot of people have built wealth because of the capital growth that they've had in their buy-to-let investments. And for some, it's passive income. So it's the rental income that you earn every month from that property. And that's, again, something that can provide someone can give the option to someone to go, become financially free. So normally there are two types of strategies to investments there. Now, anytime you don't have a tenant, you can also run the risk of having to pay the mortgage from your own pocket, which is known as a void period. So that is something that you do need to factor in, and is a risk. And as with any investment, there are upfront costs. So that includes things like stamp duty, solicitors, valuations, broker fee, application fee, which the banks charge, and ongoing costs such as the maintenance of the property, the running costs of the property, income tax, estate agency fees. So those are also something, the cost that you need to take into account. I just wanted to touch on personal or limited companies. So when buying a buy-to-let investment property, you can choose to purchase this in your own name or in a limited company name. And this is something that has happened as a result of, since 2017, when landlords saw that money they could write off for tax purposes, drop from by 25% year on year, and it's been phased in. And April this year, that's now fully implemented. So previously, before, landlords could effectively deduct finance costs. So it's things like mortgage interest from their earnings to reduce the income tax they pay. However, from 2017, the government changed this so you can no longer deduct finance costs, and instead you claim a basic 20% on 100% of the cost. Now, what this means, and I'll explain this in an example, is that landlords have to declare all the rental income and pay tax on the full amount. They claim back the 20% as credit, and for those that are higher rate taxpayers, they obviously have to pay the tax on whatever the tax bracket is, so whether that's 40% or whether that's 45%. And I'll explain this in a bit more detail. So the government implemented this to prevent the highest from earning landlords from receiving the biggest income tax relief. So this is one of the reasons why this was implemented. So if you could just move on to the next slide. I'll explain that situation, so it's a slide ahead, but before we move on to that as well, I'd like to explain what an SPV is. So in that example where I explained about why one would buy in a personal and limited, the personal route would tend to be for those people that are on the lower tax bracket. But if you were a higher rate taxpayer, they choose to go down the limited company route because there is a saving. Now, in order to go down the limited company route, you would have to set up a limited company, and that can be done through Companies House. But when you register on Companies House, there is a special purpose vehicle that you need to allocate with the company that you're setting up. So that normally is something that the lender does request it to be of a certain SIC code. And those three that I've just put on there, 68100, 68209 and 68320, are just one of several different types of SIC codes that you can choose. And I think there has been a presentation that Project Possible have done on this. So you can maybe view that video to get a bit more details on how to set that up and what SIC codes to use. So just on that example that I was explaining earlier about the personal limited company, the primary difference here is someone that's a basic tax rate payer, so i.e. someone that's earning 20%, paying 20% income tax, and someone that's paying 40 or 45. So on the left-hand side, you've got somebody that would buy a property in a limited company. Let's say their income per annum is £15,000. Let's say the mortgage interest rate is 3.49%. So the yearly interest that you'd be paying on that property is 7852.50. Now, the taxable profit is calculated by taking the yearly income, deducting the mortgage interest, and then you have what's left over as your profit. Now, within a limited company, the corporation tax at the moment is 19%. So the tax that you would pay would be 19% as opposed to 20 or anything higher. And that would be then 1358.0. So if you deduct that from the actual net profit, your total profit within a limited company is 5789.47. Now, if we move over to the right-hand side, there is an example if you owned it in your personal name. So again, the same scenario, £15,000, you would have mortgage interest at the same amount. Your taxable, now this is again a scenario for a higher rate taxpayer, where 15,000 times 40% is 6,000. Now, if you deduct that from the tax due, you've got 4429.50, meaning that you've got to be you're paying more tax by owning that property in a personal name rather than a limited company, and therefore that's an extra £3,071.47 per year that you're having saved by having that property in a limited company rather than a personal name. So this is just an example on someone that's a higher rate taxpayer. Now, in order to do this calculation, I would strongly suggest that you do sit down with an accountant to understand where your tax bracket is and how it would fit in with whether one would go down the limited company route or owning that property in a personal name. Now, in terms of the different types of buy-to-lets, so you could invest as in your first property being a standard house or flat, and that could be bought in a limited company or a personal name. You could also invest in what's known as HMO. So that stands for House of Multiple Occupation. So that sees you renting out rooms to different tenants as opposed to one whole property being rented out to one tenant. There is something called let to buy. So that's also where you could rent out your current home and you're then moving into a new property to live in. So you would do that by taking out a buy-to-let mortgage on your current place and then taking out a residential mortgage on your new home. But doing that would then allow you to potentially release some equity out of your current property, then for you to put down a deposit on the new property. There is also portfolio landlords. Just wanted to explain that someone that does have more than 4 mortgage buy-to-let properties is considered as a portfolio landlord in the eyes of a lender. Now, what that means is 2 things. That as a portfolio landlord, there will be a lot more scrutiny by the lender in terms of understanding the other properties, and they treat you as professional landlords or investors. Limitations on lenders that you can go to, a lot more paperwork, a lot more documents, potentially higher interest rates. This is where, lenders also look at it as potentially, more risk for them if, the market was to crash and you are a landlord of multiple properties. They would need to understand a bit more about your portfolio and how it's geared. Now, getting your documents together, I think it's one of the most important things, especially if you're a first-time investor. Having everything ready will set you up in making sure that once you do see a property that you want to buy, you're able to move very, very quickly. And I find that sometimes this is the bit that does let some buyers down. We end up losing some ground on time. There's always pressure on getting surveys instructed. And sometimes if there is a seller that wants to move very quickly, they would go with someone that has got everything ready and able to submit an application very, very quickly. So documents play a key role. So things that you will need is things like your identities, so passports, proof of a current address, details of your income, bank statements, where the income is paid into, proof of deposit, portfolio schedule if you already have a buy-to-let property. So they would want to know, what's the value of the property, how much is outstanding, and what rent you achieve. Cash flow. Again, we've lived through the COVID where cash flow has potentially been a problem, where there have been rental voids and tenants not paying rent. So again, just checking that, and also checking whether your tax liability is up to date, so that there is no undue tax that's outstanding. Business plans. So again, some lenders do want to understand what your business plan is, whether you're looking to invest and buy more properties, how you plan to manage the property. So many things that they do ask as part of your business plan. And again, this is something that we as brokers can help you fill out. There sometimes is more information relevant to your application, but it's on a case-by-case basis. Credit search. So credit search is very, very important. A lot of people assume that they have very good credit history, and later on there could be something that they completely missed, or a late payment they were unaware of, or even a mistake to that matter, where someone's incorrectly put down a late payment. So it's always good to keep an update on your credit file. Some lenders do a soft credit search, some do a hard credit search. So I would strongly suggest having a look at your credit file. There is credit reference agencies like checkmyfile.com where you can sign up and have a look at all your history through all the credit reference agencies. And most lenders will do a hard credit search once the full application is submitted. With credit searches, 1, 2, 3, it's okay. It's when you do multiple credit searches in quick succession that lenders maybe start looking at you and thinking, okay, well, let's find out why this guy has been to various different lenders. So I would strongly advise from not doing multiple credit searches, but do it once you're ready and wanting to proceed. There are ways to improve credit history, and that could be by paying off all your debt. A lot of people, have unused credit cards, but what they don't realize is that that can have an effect on the credit decisioning, because lenders don't like the credit facility, because that credit facility is potentially available to draw down on. So if you do have unused credit cards, or normally that is normally the bit where people don't realize. So they've used a credit card, or done a balance transfer, and they've forgotten to close it down. And it's only when you actually call up the credit card company and you say, I'd like to close it down, it's actually closed down. And sometimes when you even do that, it doesn't always happen. So, definitely closing down unused credit cards will improve your credit history. Paying off your debts on time. So any late payment, lenders don't really like, because again, if you're looking to borrow hundreds of £1,000s and you're missing out on something that's as little as £30 or £40, that doesn't give a good impression to a lender. Electoral roll, so registering to vote, that's also quite important. Very important, to be honest with you. Some people have linked addresses or haven't updated their addresses, so ensuring that that's updated on the credit file is important, because that does improve your credit history. And having a good debt to income ratio. So this does matter with buy-to-lets, and some people have potentially, let's say, £50,000 of credit cards and loans compared to their income of £50,000. So in that scenario, your debts are equal to your loan, and it might be that you can afford it, but again, lenders don't like that. So debt to income ratio is something that lenders do look at. And there is websites such as Portify which do help credit building. So something I can sort of ask you to look into, if there are some people that do have credit issues. It's a very good website to kind of help you build your credit back up again. A lot of the time we get questioned about how much we can borrow, and to be honest, the answer that we can give without getting too technical is based on the rent. And just to explain how this works, your rental income will need to be generally between 125 to 160% of your monthly mortgage payments. Now, typically it's 125, but the 160 depends on what type of property it is. So for example, if it's a HMO property, you would generally have a sort of a stress rate of 160. So in this scenario, your mortgage is £1,000 a month, you would need £1,250 as the rent. But that's not just the whole picture. The mortgage payments are calculated by stress testing the actual amount of money that you're borrowing, and that's stress tested at typically an interest rate of 5.5%, as low as the pay rate. So it could be as low as the interest rate of what the lender is providing. So that's how you come to what the actual mortgage payments are. And then there's the extra calculation on top of that, which is the 125 and 160. But this is something that we as brokers can have a conversation with. You normally let us know what the rental income is, and we can guide you in terms of roughly what amount of borrowing you can have. But that all ties in with the case itself in terms of who you are as a client and whether you'll fit that lender's criteria. So guys, that's a whistle-stop tour in terms of buy-to-lets. I mean, there's a lot to it, but if you've got any questions, feel free to ask, please.